Today, we're looking at how companies decide between leasing and buying their capital assets or equipment. Leasing offers a way to use equipment without owning it, often making it easier to manage cash flow since lease payments can be spread out and sometimes deducted for tax purposes. Leasing companies usually have deep technical knowledge and can provide valuable support, and it often allows businesses to keep up with the latest technology by updating equipment more frequently than if they owned it. Plus, leasing typically avoids large upfront costs or the need for financing that comes with buying. As we explore this topic, we'll consider both the non-financial benefits and drawbacks, as well as the financial evaluations that help businesses make the best lease or buy decisions. When you lease rather than purchase, one of the main financial drawbacks is losing out on capital allowances or tax depreciation benefits that come with owning the asset, so it's important to check the tax rules that apply in your area. Also, you won't gain any resale value when you upgrade the equipment since you don't own it. To help illustrate this, we have an example comparing leasing versus purchasing a piece of equipment. The analysis assumes the lease payments are £3,500 per year for 7 years, with a discount rate of 12.5%. If you were to buy instead, the capital cost would be £55,000, with an expected salvage value of £1,000 at the end of the period. The tax settings include a corporation tax rate of 28%, and capital allowances on plant and machinery are set at 20% on a reducing balance basis. This framework helps evaluate the financial impact of each option so you can make a more informed decision. When deciding whether to lease or buy equipment, it's best to use discounted cash flow techniques to compare the two options financially. The goal is to choose the option with the lowest net present value, or NPV, since this reflects the lowest cost when considering the time value of money. In this example, the company uses a weighted average cost of capital, or WACC, of 12.5% as the discount rate for the appraisal. Because the company pays taxes, it can offset both operating expenses and capital allowances, which helps reduce taxable income. The corporation tax rate here is 28%, and for purchasing the equipment, the company can claim a 20% reducing balance capital allowance. The lease offer is for 7 years, with annual lease payments of £3,500. If the company buys the equipment, it costs £55,000 upfront, with a resale value of £1,000 at the end of 7 years. When examining the lease option, the annual lease rental payments are offset by tax savings from deductibility, but these tax benefits are delayed because corporation tax payments usually happen 10 months after the fiscal year ends. The net cash flow each year is calculated and then discounted to find the NPV of leasing. For the purchase option, the initial cost is paid in the first year, with tax savings from capital allowances again delayed by the tax payment schedule. The salvage value is accounted for in the 7th year, and the net cash flow for each year is discounted to determine the purchase NPV. Comparing these NPVs will help identify which option is more cost-effective over the 7-year period. The financial modeling we've done uses the same discount rate and covers a period of 7 years to make a fair comparison. From this analysis, leasing appears to be the better option since it results in a lower net present value compared to purchasing. However, before making your final decision, it's crucial to carefully review the lease terms. Look out for any clauses that might affect your financial evaluation, such as required deposits or notice periods. These details can significantly impact the overall cost and flexibility of the lease, so be sure to include them in your calculations to ensure you're making the best choice.